All right, looks like we are live almost everywhere here. Okay, well, I'll get right into it. I'm Scott Anderson, the founder of Cash Cow Farmer, and today we're going to go over 5 things that we should know about hedging grain with futures contracts. Now, I'm just going to try and turn Meerkat and Periscope over here. Can you guys read that, or is it totally backwards? It's probably totally backwards. It looks backwards on my screen, but anyway. Is that backwards? Looks good. It might be hard to read, but if you can't, you can always go to the YouTube Cash Cow Farmer, and then this is going to be recorded, so everybody can watch this on YouTube eventually. It should be recorded right away. So, all right, so I'm going to get going. I'm just going to move over to the PowerPoint. I have a little PowerPoint to start and keep me organized here. So we're going to start with just going over the 5 things that you should know about hedging grain with futures and options. I'm sure a lot of people know or have heard of a farmer or heard of a story of a farmer that has lost tons of money by, messing around in the futures market. And it's crazy that futures are extremely risky. They move very fast. They're very volatile, especially right now. I mean, 10 cents a day in soybeans isn't uncommon, where it used to be 10 cents a year. So things are getting very volatile, and you can see money deteriorate very quickly when you're looking at futures and options on futures. So anyway, what are futures exactly? Well, futures are derivatives of a commodity that allows buyers or sellers of that commodity to fix prices at some point in the future. So futures manage your price risk. Basically, they make sure that you can set a price down the road, and that's determined by all the market participants, buyers and sellers, what that price is going to be down the road. So anyway, futures, they're once you start trading them, they're a lot less complicated once you get into it. So the first thing to understand is that the farmer's natural position is long. So farmers, you've either got grain in the bin, grain growing in the field, or planned intentions to grow grain. That means you're basically long. When you're long, that means that when the price goes up, you benefit. When the price goes down, you receive the consequences of lower price and lower revenues. So the farmer's natural position is long, meaning that you're going to get hurt if the price goes down. And so the first step in using futures and various other price management techniques is to get to market neutral. And you want to get to market neutral at a price that's profitable. So using some sort of software like Cash Cow Farmer or an Excel spreadsheet or something like that to determine what is your break-even point on commodities, what is your break-even point on corn and soybeans. You got to know that in order to start and figure out, where do I need to start marketing my grain for profit, and then how much profit am I going to be making every year. So if anybody has any questions, just go ahead and shoot me a message on Meerkat or on the Periscope, and let me get up the other thing here. There's also you can go to the chat box on our website here as well. It's Swedish Fish or sweetfishmedia.com/cashcowfarmer-live-webinar. So if you have any questions about futures or options or any strategies you're working on, just let me know. Happy to answer those questions if I can, or provide at least a thought about them. So getting to market neutral is the main thing that us as farmers do to manage risk. And you can do that with cash sales. You can do that with options or futures contracts. And today we're just going to go over futures and options. Cash sales are mainly forward contracts with your elevator. Just about everybody that grows corn, soybeans, and commodities are familiar with that. So let's dive into protecting the downside. So number one, if you're going to grow 100,000 bushels of corn, that's the same as buying and being long 20 futures contracts, because each futures contract is worth 5,000 bushels of corn or soybeans. So when you're going to grow 100,000 bushels of corn or soybeans, the same as being long. So the only way to offset that is to either short 20 contracts of corn and soybeans, or you can go out into call your elevator and sell contracts that way. And then you can also buy put options, or you can also sell options too, which I like to sell options. We'll go over just a couple option strategies. Options are very complex, especially in the way that they're priced, but protecting the downside can be done with selling short futures contracts. And that is basically you have a broker, whether it's somebody you call on your phone or you do it yourself. And I'm actually going to pull up my trading software and go over some potential positions and how to execute your own trades, because when you execute your own trades, it's only $3.50 for a contract, which is very inexpensive when you execute your own trades, rather than paying, I don't know, $30, $40, $50 per contract on using a regular broker. So executing your own trades can save you a ton of money. However, you got your finger on the trigger at all times. It can also lose you a lot of money if you're not disciplined about your strategy. So doubling down, and you can double down to the upside, or you can double down to the betting that the price is going to go negative. And the way to do that is either don't hedge your commodities at all, so that if the price goes up, your revenues will go up. Or you can also buy futures contracts, and then your revenues will go up as the price goes up. But you can also double the loss as well. And that's where most farmers get into trouble, is they double their loss by, for example, they'll sell short. If you're going to grow 100,000 bushels, they'll sell short 10 contracts, so they're protecting half of their grain. 50,000 bushels right there with selling short 10 contracts. The price starts to move up, so it's moved up 50 cents. So every 50 cents on the 50,000 bushels, they lost $25,000. So what they'll do is they'll see in their trading account, holy crap, I've lost $25,000, and then they'll close out that short, and then the price will come back down 25 cents or something like that. So they basically just gave $25,000 to the market, and you definitely don't want that to happen. Futures, you got to make sure that you're offsetting. If you're going to close out a futures contract, you got to make sure that you make a cash sale at the same time. Otherwise you could double your losses if you're going to lose money or wipe out any profit you potentially were going to make for that year. Another thing is, it's better to be partially right than entirely wrong. And I know a lot of people, they sold grain this year in July, a little bit of grain in July, and they're like, oh man, I wish I would have sold more. But it's better to have sold some than to have sold nothing. So it's better to be partially right than entirely wrong. So don't feel bad if you didn't sell your whole crop at $4 cash this year. There'll be an opportunity, whether we get weather or whether you can manage to get some dimes and nickels and quarters out of the market by selling options or doing some other strategies. So the fifth point here is choosing sides. And how do you choose a side? How do you figure out which direction the market is going to go? And that's of course the zillion-dollar question. I mean, if somebody knew that, you'd have your own private island and you wouldn't have to worry about anything anymore if you could figure that out. But just doing your homework, and farmers generally don't have a lot of time to do tons of homework. So I would recommend getting an advisor for your grain marketing. I use Progressive Ag in Fargo. They are very, very good. I know there's 100 advisors out there. There's Al Kleiss, there's Top Third Ag. Oh man, I mean, every local elevator will give commodities advice. Just pick the guys that are generally right and follow them. They'll help you out a lot, and that they'll help you choose which side you want to be on. So The next thing, I'm just going to talk once real quick about how options are priced, and I'm probably going to have to do a live talk just solely about options, because options are very, very complicated, and especially the way they're priced. The main thing you got to know about options, I'm sure everybody's heard this, is that 95% of options expire worthless, but there's that 5% that definitely do not, and they usually expire with pretty huge profits. So as long as you're a seller of options, you want to make sure that you're trying to get that 95%, which is low income. I mean, those are nickels and dimes you're getting when you're selling options. But if you're buying options, you're hoping to get dollars. So how are options priced? That's the main thing about an option, is how it's priced. So there's three parts to an option price, and that is the strike price, time, and then the current price of that commodity. So let's look at corn, for example. If corn is trading at $3.75 and there's a $4 strike price, an option for $4 that expires in March, then you've got 4 months of time before that option expires. And as you get closer and closer to that expiration date, that option is going to lose a penny or so every week or two as you get closer to that. Just in the time gives you a premium, because a lot can happen in that sort of time. The USDA could release a report that makes that option extremely valuable or totally worthless. A lot of things can happen. And then the current price of the commodity. So of course, if time was not involved in this equation, you would have just the strike price, that $4, and the current price of the option, which would be $3.75. So the option would be worth 25 cents, right? Well, if the option was worth 25 cents, and the option is likely not going to be worth just 25 cents. If there's 4 months down the road, it might be worth 30 or 35 cents, because you have that premium, involved in that option price of time, because you're basically trying to manage volatility with options. I mean, if you look at Warren Buffett talks about options, he's used options before. Every top famous money manager has used options. They are a play on volatility, and the more volatile the prices swings are, the more expensive the options are. And so anyway, I'm going to pull up my trading software and go over a few things. So I use Thinkorswim by TD Ameritrade, and I do all my futures trading through TD Ameritrade. If you want to get started, just go to tdameritrade.com and sign up for account. I'm not sure what the minimum is you have to put in. I think if you want to trade futures and options and stuff like that, it's probably $10,000. But if you're a farmer and you've got 1,000 acres or more, you're gonna need at least that to manage your risk. So I know it's going to be hard to see this on Meerkat. It looks like there's a giant sun in the middle of my screen on Meerkat and Periscope. But if anybody has any questions, just message me. Be happy to do my best to answer them, because this stuff is complicated. If you got any ideas or strategies, just shoot them out there. Happy to talk about them or just test one out. So this is a 1-year chart. I use candlestick charts because candles will tell you a lot about the price action in a commodity. So if it's a red candle, that means it opened higher than it closed. It went down that day. And if it's a green candle, then it did the reverse. It went up that day. And then the wick, of course, is the high and low of the trading day. So as you can see, the best time to sell, soybeans, looking at the December, the harvest contract, would have been right there in July. We had that nice spike in July because of the too much rain, and that would have been a great time to sell. But that was right around that 1020. I guess the futures just crossed 1040 on 2 occasions. But anyway, now we're looking at 857.75. That's what they closed on Friday. So what is really your options at this point? And that's the $1 million question, is what are your options at this point? So if you've got grain in the bin, of course, when the futures go up, you're gonna increase your your value of the grain bin. If the futures go down, you're going to lose money. And that's kind of the whole point of using futures and options, is to manage that risk. And I want to just say, do not use one strategy for the whole farm. Do not sell options on every bushel that you're going to grow. Do not just pick one strategy and blanket it against the whole farm. It's that don't have all your eggs in one basket strategy. You want to make sure that you're diversified. So you might want to sell some options. You might want to sell some futures short. And when you're selling options, you could sell calls. If you think the price is going to do nothing or go down, then sell a call, because calls become more valuable as the price goes up. So if you think the price is going to just fluctuate and then maybe go down a little bit, then selling calls will get you that premium. That premium will eventually become worthless unless that commodity spikes in the direction of that option. Calls obviously is a bet that the price is going to go up, and puts are a bet that the price is going to go down. So if you're selling a put, you're thinking that the price will either do nothing or it will go up. And when we're at record low like this, I mean, selling puts might be an okay strategy. Of course, if you're not hedged with shorting futures on your grain that's in the bin, you're going to have a hard time. You might double your loss by selling puts, because if it does go down, those puts are going to become more and more valuable, and you're going to really take it in the shorts on that sort of thing. So I really like this trading software. You can do just about anything with it. So this is just what a chart looks like. But what we're going to do is we're going to go into corn. We're going to look at all the various contracts. There's like 5 or 6 corn contracts every year. And, each contract trades at a little bit different price. Like right now, the active contract is March 16. The next contract is May 16, July 16, September 16, and then December 16. So if you want to look, just if anybody's curious, December 16 is $3.91. And right now we're trading at $3.70. So 21-cent premium is what next year's corn's at. So I know a lot of people that would sell this year's corn for $3.91. So if you're thinking about, managing risk for next year, and you're going to grow 100,000 or 500,000 bushels of corn, you might want to throw a few shorts out there, 20 contracts, short 100,000 bushels, and make sure that you're not going to, if it goes down further, then you're really going to get creamed if you didn't short some of that, So you've got all the contracts up here at the top, and then down here you've got all the option strings. So is anybody curious what a December 16, let's say a $4, let me open more strikes here. So a $4, if you were to buy a $4 put for December 16, that cost you 40 cents. That's the premium right now, 40 cents. And that's because December 16 is almost a year away at this point, so it's over a year away, but the contracts don't actually close on December 16th. That December contract will switch over in November. But anyway, that's 40 cents. So that would lock you in on every put that you bought. That would lock you in at $3.60. And December, remember, it's $4. That strike price is $4. That's where the time value comes in, and the trading price is only $3.91. So it's right close to that strike price. However, it's almost 1 year away. So that's where the premium comes in, and it makes those options extremely valuable. So that's one strategy. You could start buying puts for 40 cents. That's the ask. The last traded put was 38 cents. So I mean, still you're looking at 30-cent premium just for that 12-month time period. And if the price stays the same, doesn't do anything, that option will eventually expire worthless. Or you can then convert that option into a $4 short, short $4 December short contract and collect the difference there. But again, that time value is expensive when you go 1 year out and more. But let's look at the March or the May. Well, let's look at July. A lot of people like the haul grain in July. So let's look at July. July is trading right now at $3.81, just 10 cents less than, 11 cents more than the March. March is 370, so July 381 right now. And let's say you wanted to buy a 380 put. It's going to cost you about 25 cents to buy a 380 put, which is going to put you at 355. That's going to be your floor that you set with that option if you wanted to buy one. But you know what? What I like to do, if I've already got the grain in the bin, I like to sell calls. And selling calls can get you dimes and nickels out of the market pretty nicely. So, for example, if you were to sell that 380 call for 25, the last price call was 25 cents, 25.875 cents, so almost 26 cents. So if you were to sell that call and the grain went up, the market went up, yeah, your call that call that you sold is going to become more expensive. So you're going to lose a little bit of money on that call. Remember, you sold that for 25 cents. So you take 380 and you add 25 cents to it. So now you're at 405. That's if the price goes up. You've set for whatever you sold, you set that price at 405 because you get that when you sell an option, you get that money into your account. However, if it goes against you, then you protect the downside by another 25 cents. So whatever the price is trading at, the most you can get out of that is 25 cents. Unless of course it goes up, then you're going to lose some money, but you're set your roof for those grain bushels, at $4.05. So I know this can get confusing, and I'd like to do something just on options and just show the screen and execute a few trades and then follow up in a couple of weeks and do that, just kind of like the false portfolio of different strategies, and then measure which ones were the most successful and which ones were not. So if you've got 100,000 bushels sitting on farm storage right now, you've got a handful of things that you can do. One thing you can do is sell some futures on that. Another thing you can do is to sell some forward contracts on that grain to the elevator or whoever you're gonna go with for your salesperson there. And then you can also do options. You can sell options or you can buy options. There's so many options to do out there. It's just crazy. It's almost mind-boggling to try and figure all this stuff out. But another strategy that some farmers have told me about is with the price what it is right now, and then people are kind of speculating we might have an El Nino year next year, which an El Nino year could cause a huge drought somewhere, and then that would drive the price up like crazy. So if that happens, then you could buy let's just look at the options for the December options. December 16. So you could buy, let's say you bought a $5 call option for 8 cents or something like that. Last one traded at 8.75. So you bought that call option for 8 cents, and then the price of corn just shot up to $6. Well, that call option would become extremely valuable at that point in time, and you'd make a lot of money on those calls that you bought, and you only paid 8 cents. So the max you can lose is the premium, which is 8 cents. So boy, it helped somebody asked a few questions. Does anybody have any questions? I'm more than happy to kind of talk over some questions here. If anybody's got some strategies they wanted to throw out there or anything like that. So, I mean, there's a lot of different things you can do in grain marketing, but I would recommend opening up your own account. It's $3 to buy an option, $3 to sell an option when you do it yourself, and $3.50 to buy a futures contract, $3.50 to sell a futures contract when you do it yourself. So you're looking at $6 to $7 round trip in and out of a position for each contract. Each contract will protect 5,000 bushels. So, there's a lot of different options that you can do. So I'll just give it a couple minutes and let anybody ask questions if they've got any questions. You know, commodities, they move. There's some people that they call technical analysis analysts, and then some people which are fundamentals. And commodities trend are set by fundamental expectations, but the technical analysis is, yeah, ETFs. Had somebody, oh, I recommend just a question on where to open an account. You can go to Schwab, you can go to Scottrade, you can do TD Ameritrade is where I go through. So those prices are through TD Ameritrade. That $3 for an option, $3.50. Yeah, TD Ameritrade's great. But ETFs are exchange traded funds. They are a derivative of futures of a basket of commodities or stocks or something like that. So when you buy an ETF, the manager of that fund will go out then and buy those contracts. You don't have to manage the contracts. ETFs are pretty, they flow. You want to make sure that you're looking at a chart of that future for wheat. Somebody asked me about wheat ETFs. Make sure that you're looking at the wheat futures and you're looking at a chart of the wheat ETF, and you want to make sure that those are almost identical, because the last thing you want to do is hedge your risk with an ETF and then have the price of wheat go way down, and then the ETF doesn't move accordingly to that, and your hedge could be not very high quality or not protecting you like it's supposed to. So I just go out there and straight up buy the futures, because, you know, even though it's risky, I've got farmers are probably of the riskiest businesses in the world. And, you know, if you don't manage your risk, you're going to get wiped out. And nowadays the prices move so rapidly that you got to manage your risk. And that's extremely important. So, but yeah, TD Ameritrade, I don't know what the minimum is to do futures, but you have to have a margin account and you have to have options in futures. So when you sign up, they'll give you access to commodities, but then you have to, it's very fast to do that. You just go to your account online, and then there's a few things that you got to click. Yes, I understand that this is super risky. And yes, I understand that. So, well, thanks for watching charts here. So yeah, there's a lot of different things you can do, but yeah, it's just walk through the steps. It's way better than not having, you know, any sort of, it's riskier to do nothing than to manage your risk with futures contracts and stuff like that. If people are watching on YouTube and you always see me looking off to the left, that's because I've got two cell phones. I got Meerkat and Periscope on there. So if it looks like, if you're just looking at the side of my face all the time, sorry, but I've got questions popping up over there and whatnot. So any questions, keep them coming. I'm more than happy to hang out for a bit. I'll hang out for another 5 or 10 minutes and answer any questions, go over anything. What you're seeing on my computer screen is Thinkorswim by TD Ameritrade. When you sign up for TD Ameritrade and you build an account, you're going to want to download Thinkorswim. It's a trading platform on your computer. Also download the iPhone app or the Android app. The apps are awesome for TD Ameritrade. They're just fantastic. I can be in the tractor, anywhere I got an internet connection, I can check real-time prices at any time. I just pull up, log into my app, and I can check real-time price of equities, of the futures market, of corn, everything. So I could be sitting at the elevator and say, hey, I want to sell some corn. What's your price? And I can be watching it to make sure that they give me the right price there. So that's pretty awesome. Real time, and it's totally free. Like, It's totally free. They just get a commission for executing the trades. The way they make money at TD Ameritrade, they're a bank basically, but they get money. They get commissions for brokering and brokering the sale, and then they also get they borrow the money just like a regular bank. So they pay you a marginal interest rate on your money on the bank, and then they borrow that out. So TD Ameritrade is just like a regular bank. The one thing I like about TD Ameritrade is there's locations all over the place. You know, especially when you get to the larger cities and whatnot, you get locations TD Ameritrade that you can go in. And I think if you have once you have a TD Ameritrade account, you get a debit card. I think it's no ATM fees ever at all. That's pretty awesome. So if anybody has questions on how to use this Thinkorswim platform, I'm more than happy to show you how I use it, which there's a million ways to use this stuff, but I use it a certain way for what I do, which would probably be relative to how most farmers use it. So I hope all this isn't showing up totally backwards because I'm using the camera to record a computer screen. But anyway, you can go to YouTube, Cash Cow Farmer, and then you can watch this recorded live talk on YouTube. So any questions, keep them coming if you got any questions. Questions about futures, options on futures, any strategies might have questions on. Does anybody here trade options or options on futures right now? Futures or options? Anybody trade futures or options right now? You know, of all the farmers that I talk to, probably 5% I would say trade futures, and they're usually a very successful 5% too that are doing that. And what I would recommend, if you've never traded futures or options on futures before, just do one contract at a time until you get used to it. Just marginally increase the number of contracts, because even if you're a huge farmer and you're growing 500,000 or 1 million bushels, I mean, that's 1 million bushel is 200 contracts. So, I mean, every dollar up and dollar down in corn, for example, you're going to make or lose $1 million. And the same with your paper account, you know, which is all the electronic money in your trading account. So if you've never done it before, just do one contract. And I make sure that I always own or am short at least one contract of corn and soybeans at all times. So it forces me to pay attention every single day, because every single day I get up and I check the markets, because I know I've got money on the line every single day. So when I see that I either made or lost money, I'm much more interested in watching the markets every day. Here's a question. Used to trade stocks, but I jumped into the Forex market. Yeah, Forex can move quick too, especially Forex is a tricky market. You really have to understand politics for Forex, you know, and there's in politics, and not only your local politics, but you got to understand all the other currencies, the top currencies. You got to understand what's going on in every country. I know Argentina, I think it's today, Argentina is supposed to get their election. For you that trade Forex, Argentina is supposed to get their new president, or whatever they call him down there, in today. And there's some of those candidates were going to put a whole bunch of commodities on the market. You know, that politics it kind of makes the currency. And then, you know, with the United States, of course, it's the Federal Reserve has a lot of impact on it. And then it's all relative as well, especially in Forex. You know, a lot of people have been saying the United States dollar is going to collapse for years, but you know, when all the other currencies are worse than the dollar, it actually looks pretty good. So the interest rate on the United States dollar is very low, which makes it not very attractive. But when all the other currencies, such as the euro, Canadian dollar, are just getting destroyed, you know, the Russian ruble, Brazilian real is down huge. All those South American currencies just getting destroyed. You know, that just, who would have thought the dollar would have gone up so much in the last year? Not very many, handful of people. March 17 corn, $4 for those folks that want to go way out. You know, you can even trade December 2017. It's ZCZ7. That is $4.01 right now. And it's December 18 is the longest I can go with this platform, I guess, right now. December 18 is $4.09. So that's 1,104 days before that contract expires. So imagine it was 2012. Let's go back in time to 2012. Hello from Romania. Imagine going back to 2012 and just saying, well, you know, everything else is trading around $6. I'm just going to sell short, you know, half my production for the next 3 years, all the way up through 2016. Imagine if I was the Back to the Future guys and I had the time machine, that's what I would do. I'd go back and I'd hedge the next 3 years and sell short those futures contracts and protect against the price that we have right now. Because I mean, $6 is a heck of a lot better than $4. I mean, making $2 ahead. So, but remember, in 2012, our nearby price was $8 or $7, and it was hard to sell to say, well, $6 next year, won't be able to make any money at $6. Well, now we're trying to make money at $4 and $3. And then in my area, the local cash price is right around that 310, 315 area. It's been fluctuating there. The basis has come down really well, which is good for most farmers. You know, basis management is another category in the whole marketing, the whole grain marketing, multifaceted challenge here. And I mean, if you've got on-farm storage, you can manage that basis. But remember, it also costs money to unload and load those trucks every time, and to maintain that storage and stuff like that. So that basis has to come down quite a bit to pay for that. I would say 20 cents is right around what it costs for me to load and unload the truck, and then it's about 5 to 10 cents a year just for the storage. So that's 30 cents. You know, so you really have to be very efficient with your grain marketing storage to make money on that. Let's get some more questions here. The Forex guy, if you're still on, who do you trade your Forex through? Just if some other people have some experience with other platforms. I've used TD Ameritrade since I was 19 years old in college, and I've used it for 11 years, so I'm really happy with that program. I've been tempted to switch to a handful of other ones. Interactive Brokers is another pretty decent platform from what I've heard. I know some people that manage a lot of money that use Interactive Brokers. It's similar to the Wall Street thing, where instead of just paying $10 for a stock trade, regardless of the volume, you pay per contract, and I think it's just a few cents per contract. But yeah, if anybody else is using other platforms, you could share what platforms those are in your experience. Been very happy with TD Ameritrade though, very happy. So they've got a lot of really nice screens and data and watch lists and triggers and stuff like that. It's really, really handy program to use. So one thing I just want to show some people, when you're looking at specific contracts, you can search for, what do I think of Scottrade? I've never used Scottrade. I think it's a little bit cheaper on equities if you want to trade equities. You know, I think it's $5 or $7.50 to buy and then the same to exit that trade. But I think it's good. My name is Scott, so I definitely like the name of it. Yeah, I mean, they're all going to be about the same. Execution is really good, and what I mean by execution is that if you boom, what I mean by execution is that, take this chart for example. This is corn for the last 1 year, and there's our July spike. So you see, it didn't spend a lot of time above 450, but if you got a good broker and you put in that 450, I guess the high was 454. If you got a good execution, means that if you put in 450 and it goes to 451 and then shoots down, that your broker executed that trade in the market before the volume got used up and spin back down. So the execution on TD Ameritrade, in my experience, on both equities and futures, has been extremely good, extremely good. So another way to hedge your grain is with Forex. Using Forex is another way to hedge your grain, just like the guy on Meerkat had mentioned Forex, that he's trading the Forex market. So as the United States dollar gets stronger, our commodities become more expensive for the world. So one thing that you could do is you could buy, US dollars or an index that trades the US dollar. So as that goes up in value, your Forex position increases in value. However, the commodities go down in value. So a few things that I like to watch, and I'm just going to show you a few nice little tricks. So I just split this screen into 4 different charts. So the main charts that I watch right now, I watch the common corn chart, which is going to have all the contracts which for corn. I like to watch QM, and QM is crude oil. That's extremely important, especially for farming, and especially since farming has become, our corn has become an energy commodity as well. So I like to watch QM, and then of course ZS, which is the soybeans contract there. And then I also like to watch, is it DXY? Yeah, DXY, the dollar. So at all times, I have a screen up that has corn, oil, soybeans, and the dollar. And I have one computer in my office that only has the stock market and futures on it. And it's got 3 screens. So it's got my computer screen, and it's got another screen here, and then another screen on the left. And so basically, I've got a quad chart on each one of these showing 4 different things. And I've got corn and soybeans on one screen that has both ZCZS, and then I'll pick a specific contract. For example, on one screen, I'll have ZCZ6, which is going to be next year's corn. I don't know why this thing. I'm going to try and get. It's got volume or open interest. Let me remove open interest here. In the world. So I like the chart to overlap the volume so that it doesn't take up space. Like, see these 2 charts on the top? They're just the chart, and then the blue lines in the background are the volume lines. I think volume is very important to look at. I don't know why. This is the first time I've used this. This is not like the live trading. This is the simulated trading, which is nice. Hello from the United States, Russian person. So that's nice that you can have live trading and then non-live trading. Then you can throw in some ideas and see how you would have done had you have executed those ideas. So I've got the common corn, which is going to show all the charts, and then I always watch the next harvest chart, which for soybeans is ZSX6 on TD Ameritrade anyway. That's what it is. So if you're watching online, you can see that I've edited a lot of these charts. I just changed the volume so that it's overlaid so that the chart looks a little cleaner. So this is what one screen will look like for me. It'll have corn and then next year's corn crop and soybeans. So next year's soybeans is $879.50. So we're at quite a premium for next year's soybeans. So anyway, just want to talk about Cash Cow Farmer a little bit. I guess I should have done that way earlier. But anyway, we help you manage your production costs and your inventory and your marketing contracts. So when you have a whole pile of fields in your farming operation, it's very challenging to figure out which fields are profitable and which fields are not profitable. And a handful of losers can really kill your profitability on the farm. And one of the most important things as a farmer is to manage the losses and to make sure that you are making money on every field that you farm. So Cash Cow, that's basically what we do is we help you. It's an online software program that you will put in the prices you pay for your inputs, and then you'll put what you applied on every field, and then we'll calculate for you. We'll convert all that from tons to pounds to dollars per acre to dollars per bushel. So you'll know on every field how much it costs you to produce a bushel of corn or soybeans. Secondly, we pull in the live futures and you set your basis, and we pull in the live futures, and then you can determine exactly in a cash situation, because it all boils down to cash from a farmer's perspective. So you can tell exactly from a cash basis what your exact income was on each individual farm, and then your entire farm as a whole, and then each commodity, of course, corn and soybeans. So sign up for a free trial. It's totally free. cashcowfarmer.com. If you have any questions, you can email me, scott@cashcowfarmer.com. But hope this was helpful. If anybody has any questions or wants any ideas for further talks, just let me know. Email me, scott@cashcowfarmer.com. I'm probably going to do a little bit more on options, and maybe I'll do like a weekly one where I'll put in a couple strategies, and then we can revisit those strategies every week to see which ones are winning, which ones are losing. So thanks for watching, and everybody have a great day.